Hi guys, it's me, Teresa Perrin. I just wanted to bring you an update on System1, ticker S as in Sam, S as in Sam, T as in Tango. That's SST. And the beginning of this call, I will go over the media, what they're reporting on earnings. Then I will give you a bullet of the important facts from the System1 earnings call. And the remainder of the call will be the actual earnings call, or the remaining of the video rather. So let's get into the System1 earnings. They reported late this afternoon a Q2 loss of $34.1 million compared with an $11.8 million profit a year earlier. Revenue for the quarter was $219.8 million, up from $169.6 million a year earlier. So that was an increase because it was $219.8 million this quarter, and year over year it was $169.6 in the prior year. 4 analysts surveyed by Capital IQ expected a $235.2 million quarter of revenue. So guys, it was a miss as far as revenue goes, and the company said that it now expects 2022 pro forma revenue between $900 million and $930 million compared with $1 billion previously projected. And the analysts projected a revenue of $997.4 million. So that also is falling short, which is why the stock is down in the after hours. However, I am going to get into some very exciting news in the next segment. So I think you're going to like what you hear. And I do see a lot of potential going forward with System1. This is a heavily favored retail stock, and it's had some wild swings, guys. So anything's possible, but with the news, when it breaks regarding what I'm going to report in the next segment, it could be very bullish for this stock. So let's hope it is. Anyways, thank you so much for watching. If you could just like and subscribe, I'd greatly appreciate it. Thank you. Okay, guys, so SST's revenue grew 30% year over year to $220 million. Revenue grew 7% year over year on a pro forma basis. The gross profit grew 55% year over year to $67 million. Adjusted gross profit grew 31% year over year to $74 million on a pro forma basis. The net loss was $34 million. Adjusted Ebitda increased 20% to $41 million compared to $34 million in the prior year on a pro forma basis. The news that's so exciting and I can't wait to share is that the company announced a $25 million stock and warrant repurchase program. Guys, that's huge because they're going to buy back $25 million worth of stock and warrants, taking them off the market, lowering the free float. This is fabulous, fabulous news for us. The company updated the full year 2022 guidance to $900 million to $930 million of pro forma revenue, $285 million to $295 million of pro forma adjusted gross profit, and $155 million to $165 million of pro forma adjusted Ebitda. Guys, the rest of the video, like I said, will be the actual call. And again, I apologize if it starts a bit late or ends a bit early because, like I said, I was juggling 3 calls today, but I wanted to get this to you. The best news of the day was obviously the stock buyback program. Thank you for watching. Let's get into the call.
Months, the market resets downward in July and then bounces back towards the end of summer. This July, the drop is more pronounced than it's been in recent years, and the market is recovering more slowly than typical. We believe this is due to inflation affecting buying habits and potentially from increased summer travel. While we do have the ability to get more aggressive on the buy side during a downturn, we've decided to stay a bit cautious so far this quarter. We're keeping a close eye on the ad markets and are beginning to see things stabilize and rebound, as they always do. As the market moves, we are shifting marketing to the most in-demand verticals and increasing our buy-side efforts on native and social networks. And as we are continuing to push our international expansion. Now, moving on to our subscription business, we saw a nice performance in Q2. We continue to see improved retention and upsell metrics from our flagship antivirus product, Total AV. We added 319,000 new subscribers, including more than 100,000 from our newer Total AdBlock product. We also launched a new product, a Browser Booster, which is a browser extension that speeds up a user's browsing experience. And we have more products set to launch later this year. The subscription team continues to be focused on retaining existing customers, opening new customer acquisition channels, and launching new products. The team is doing a great job, and I'm really excited about our near-term and long-term opportunities in subscription. Overall, we remain very bullish. We're going to keep investing in product and engineering, and we do not expect our investing to slow down. Our management team has been through macro headwinds several times, including 2008, and of course, the onset of COVID-19 in 2020. Each time we've invested through these cycles, and each time it has paid off. Times like these are when the diversification in our business model really shines. As areas like online shopping dip a bit, other advertising verticals like consumer finance open up. And at the same time digital advertising overall is facing headwinds, we're seeing opportunities open up in our subscription business. So while we are keeping a close eye on the short-term macro trends, we are playing for the long term. I'm confident in our technology advantage, our diversification, and our long-term growth story. I'll now hand things off to Treaty to discuss this quarter's results and updated guidance. Take it away, Treaty.
Thanks, Michael. As previously mentioned, we are excited about the results we delivered in Q2. And despite any short-term headwinds we might see for the rest of this year, we remain very bullish about the business. To start, I wanted to provide more color on the fraudulent traffic issue Michael mentioned earlier. Since Q1, we had been significantly growing our marketing spend with Microsoft's Bing advertising partner network. Late in Q2, it was identified that this network was sending System1 material amounts of fraudulent traffic. In plain English, we were paying for clicks that were generated by bots, not humans. Our analysis shows that these fraudulent clicks originated from websites owned by two large publishers on the Bing partner network, IAC and CBS Interactive. As a result of this fraudulent traffic, our revenue was impacted by $11 million, which is the amount refunded to our advertising partners. The impact to gross profit, net of any refunds received from Microsoft in Q2 of 2022, was $6 million. In this specific event, while Microsoft has acknowledged the fraudulent traffic and issued us a credit, our analysis shows that we have not yet been made whole. This type of event is rare, and even more rare is the advertising network not providing a full refund. Our data strongly shows that we are due an incremental ad credit from Microsoft, and we are committed to pursuing all avenues available to us to be made whole. As a result, we've added back the net impact of this issue in our reported adjusted gross profit and adjusted Ebitda metrics for this quarter. Before diving into the rest of our Q2 results, I wanted to start with a reminder of our operating philosophy. Gross profit dollar generation is the ultimate metric we use to measure the effectiveness of our Ramp platform. We see Ramp as the key to growth by enabling more marketing spend and driving operating leverage through optimizations. Also, when I talk about our financial performance, and specifically year-over-year results, in every case I will be referring to pro forma financial metrics inclusive of Protected.net's results in prior periods. For a reconciliation of these metrics to our GAAP financials, please refer to the reconciliation tables in the earnings release issued earlier today. Let's move on to Q2 results. Revenue was $220 million as compared to $206 million last year, a 7% year-over-year increase on a pro forma basis. Adjusted gross profit was $74 million, an increase of 31% compared to last year's pro forma gross profit of $56 million, with all segments of the business contributing to that increase. Adjusted Ebitda was $41 million versus $34 million last year, and above the high end of guidance by $3 million. In general, similar to what we've seen in moments of dislocation in the past, as advertisers pulled back overall spend, the last dollars they pull are in the pay-for-performance categories, where Ramp excels. We were able to take advantage of this trend in Q2 ahead of the larger macro pullback for the back half of the year, and it lends further validation to our business model and the platform in the long term. On the advertising front, we acquired over 1 billion sessions to our owned and operated advertising properties in the quarter, reflecting a 32% increase year over year. Our cost per session was 12 cents, with corresponding monetization of 16 cents per session, which maintains our spread of 4 cents sequentially and represents a spread of 35%. Excluding the impact of the fraudulent ad traffic issue, our cost per session was 11 cents, and our spread would have been 42%. Our network advertising business also delivered a strong quarter, with revenue up 52%, network RPS up 41%, and network sessions up 8% year over year. Overall, advertising revenue less advertising spend was up 21% year over year. The subscription business performed well, with revenue up 19% and segment profit up 26% year over year. We continue to benefit from the shift to renewing customers and our ability to retain and upsell the large total AV user base. Subscriber ARPU was $20.17 in the quarter versus $18.76 last year. Total subscribers were up 1% sequentially and 5% year over year. Change in deferred revenue, which represents the delta between GAAP subscription revenue and billings, was $3.5 million in the quarter. In our guidance for the year, we assume change in deferred revenue remains flat with a similar seasonal spread through the quarters as last year. Operating expenses, net of add backs, were $32.5 million for the second quarter of 2022, compared to $21.7 million last year. The year-over-year increase is reflective of our continued investment in ramp, increased headcount from our transition to a public company, and increased public company costs. Operating expenses as a percentage of adjusted gross profit was 44% for the second quarter of 2022, compared to 50% last quarter. With respect to liquidity, we ended the quarter with $37 million of cash on the balance sheet. Gross debt was $444 million, which includes the $49 million revolver drawdown to finance the CouponFollow acquisition. As of June 30th, LTM billings-based Ebitda, as defined by our credit facility, was $159 million, resulting in a net leverage ratio of 2.55 times. We plan to actively pay down the revolver via our operating cash flow in the second half of the year. Now, on to guidance. Through the first 6 weeks of Q3, and consistent with the earnings announcements of our peers, we have seen a significant softening in the advertising market, driven by the macroeconomic environment. Despite the choppy start to the quarter, we believe the current trends are temporary. We expect advertising dollars and volume to come back to the market, and consistent with historic trends, we expect those dollars to come back first to performance-based advertising platforms. As we've seen in the past, when ad markets rebound, we've historically seen acceleration in our business. Our overall views on our business model remain unchanged. Our management team has been through many of these cycles in the past. Our guidance also reflects the financial impact of the marketing we previously had planned to do with Bing. Due to the fraudulent traffic issues I discussed earlier, we currently have materially reduced our advertising spend with Bing. Because this is a higher volume but lower margin business for us, the result is substantially lower gross revenue combined with higher gross margins. Additionally, we are seeing several pockets of new subscriber growth in our subscription business. While this is very positive, the short-term effect of increased customer acquisition is upfront marketing spend ahead of increased renewals and profitability next year. As a result of the combination of these internal trends, coupled with macroeconomic trends we discussed earlier, we have determined it is more appropriate to provide full year guidance versus specific Q3 guidance. This gives us the flexibility to pull acquisition levers as we deem necessary to take advantage of new sources of subscriber growth. We will provide an update on both of these trends during our next earnings announcement. For the full year, we expect revenue to be between $900 million and $930 million, representing 10% growth at the midpoint. Adjusted gross profit to be between $285 and $295 million, representing 36% growth at the midpoint, and adjusted EBITDA to be between $155 and $165 million, representing 26% year-over-year growth at the midpoint. Our lower revenue guidance reflects our currently reduced marketing spend with Bing as well as our conservative view on buy-side spending as ad markets stabilize. The adjusted EBITDA guidance reflects a forecast of limited recovery in the macro environment, as well as our desire to maintain optionality to increase customer acquisition spend through the end of the year. Finally, I'm excited to announce that our board of directors has approved a repurchase program for both common shares and public warrants of up to $25 million. This program reflects both the company's and the board's confidence in our business model and platform. I want to reiterate that while the macro conditions have caused us to reduce our full-year outlook, we view this as a temporary change as markets stabilize. Ultimately, this is a business that's going to conservatively grow gross profit by more than 35% and EBITDA by more than 20% at the low end of the range. We have a proven platform that thrives in these environments and a plethora of opportunities in front of us, both organic and via M&A. We are excited about our prospects and bullish about the opportunity. Thank you for joining us today, and now let's go to questions.
KLXE.
Thank you, Tridi. We will now go to live Q&A. The first question is from Shweta Kajaria with Evercore ISI. Shweta?
Okay. Hello. I guess I have two questions. First is, with Bing, it sounds like you are pulling back on spend, but would you offset that pullback by diverting that to perhaps Google or someplace else? And if not, why not? And second is, you said you're staying cautious on the buy side, but if you are managing to gross profit dollars, then I would imagine that, you know, you're sort of optimizing it for gross profit. So if there's, I'm trying to understand why your gross profit annual guide would be lower if the spread remains the same.
Yeah, sure. So I'll handle the first question, Shweta. Good to see you, and then Tridi the second. So related to our Bing spend, yeah, we pulled back substantially in that network, almost to zero. We are watching it very closely so we can get confidence to kind of scale back up on the Bing side, and our guidance does reflect not scaling back up with Bing, although we hope to be able to. In regards to moving spend around, think of Bing as just another source for us. All of our other sources, we are continuing to maximize as much as we can right now. Market's been pretty choppy and volatile for the past few weeks. Certainly it reset pretty heavily in July, as we mentioned, and we are seeing things stabilize pretty good amount the last couple weeks, but we didn't want in our guidance, forward guidance, to count on that. But we are seeing some green shoots, I would say, in the market. And then, Tridi, do you want to handle the second question?
Sure. And really just, piggybacking off of what Michael just said, the choppiness in the ad markets really is what's driving the cautiousness, both in our guidance and just how we're operating in the marketplace right now. So while we are maintaining that spread, our algorithms, as advertisers are moving in and out and demand is moving around, it takes us some time to kind of learn and execute against that. So really what you're seeing in the guidance, Shweta, is just our conservatism around, waiting for the market to stabilize, which, as Michael said, we started to see very recently. And as that happens, our algorithms learn, we expect to be able to ramp back up our spend. And to your point, continue to drive that gross profit and maintain that spread.
Okay. Thanks, Michael. Thanks, Tridi.
Thank you.
Thank you.
Our next question comes from Victoria James with D.A. Davidson. Victoria, please go ahead with your question.
All right. Thank you for taking my question. So I have one question and one follow-up, but I will ask them one at a time. So my first question then is, how should investors think about System1's ability to take advantage of the disruption in the digital advertising market, such as with Apple's focus on privacy and then Google eventually removing cookies?
Yeah. Thanks, and thanks for calling in. So yeah, we do like disruptions in the marketplaces. So in terms of things related to the Apple changes and things getting more private, that's good for our system. We July was actually pretty volatile overall. It was pretty similar to, I would say, April 2020, when the ad markets had a pretty big reset right around when COVID hit. So in that case, and if you go back to April 2020, we stayed in market pretty heavily and had in April, had a pretty down April in 2020. We learned from that experience, and so when we saw the particularly the pay-per-click markets reset in July, we decided to be much more cautious this time. So I think that answers your question.
If I could just add to that, Victoria, just two other points. One is we did have, as the advertisers started to pull out of the market towards the end of Q2, we actually had a really good Q2 in terms of, as we saw ad spend really kind of retreat to the performance marketplaces where Ramp shines. And secondly, just I think you mentioned specifically kind of Google going cookieless. That's also kind of, to Michael's point, another place where we expect our platform to really outperform there as well. So we don't rely on cookies. We're specifically first party data, so that's another opportunity for us when it happens.
All right. And then my other question, I feel like we've touched on a little bit in your answer here and maybe a bit in your opening remarks, but I just wanted to ask it a little bit more explicitly. So for investors who maybe were not following the story in 2008 or 2020, can you talk a little bit more about what is allowing you to outperform during those times of market downturn?
Yeah, so our system's set up to take advantages of dislocations between markets. We, think of what we're doing specifically on the advertising side. What we're doing is we're typically buying on one market and finding, a place to sell on the other market to advertise at a higher price. And so as markets are moving around and, like display markets, if they're dropping in pricing and pay-per-click markets are increasing, we're gonna move heavily into display and sell to our pay-per-click providers. In this particular case, so that's how things work, in normally 99% of the time. In this particular case, in July specifically, the first 4 or 5 weeks of the quarter, what we saw is pay-per-click markets overall in almost every category that we're in became depressed relatively quickly when the markets reset in July. And then on our buy side, we've been seeing a bit of volatility. And kind of as I mentioned, we don't necessarily need up markets or down markets. We can take advantage of our spread in most markets, but we do look for some level of stability that allows us to figure out the ad verticals that are going to be most profitable for us, and also the buy side and sell side places that are going to increase our spread the most. So anyway, and we have history of doing this, and most recently was 2020, where that was a dislocation like no one's ever seen before, and we stayed in market. It took us about 6 or 8 weeks to kind of figure out where the pockets were, and as I said, we're starting to see that. We did not put we really based our guidance off what we've seen so far in the quarter. And, our guidance is also combined with, as we've mentioned, we're seeing some pretty good pockets of opportunity on the subscription side to go in and acquire customers at larger scale while maintaining our cost to acquire goals.
VTEX.
The next question comes from Nat Schindler with BofA. Nat?
Hey guys, thanks. Couple questions. One, and I think you've been touching on this the whole time, and everybody's asking about it, but more explicitly, because you're in both the buy side and the sell side of any advertising transaction, how quickly can your systems learn so that you can protect profit in an advertising recession? And do you think over, as long as you're given some time to figure it out, that you could actually maintain the same level of profitability regardless of the macro movement, as long as it isn't too abrupt. And then I have some other follow-up questions.
Yeah, no, and thanks for joining. Yeah, no, so we have historically over, since our founding, been able to maintain that spread through good markets and bad markets. We're looking for stability. As I said, we're starting to see it in the markets on the advertising side. So yeah, we're highly confident. Treaty, reported good spread. We're continuing to see that on our advertising side. So, but what we've been is a bit conservative. As we were seeing the markets, fluctuate, with the quarter reset, we decided to be a little bit more conservative, but we're still maintaining spread, as we always have. One kind of just interesting little tidbit, which has affected us more on the, where you're looking at our gross revenue, our total revenue projections. We play on the desktop and mobile are the two major areas where we play. On the desktop side, we're seeing a bit of reduced consumer queries, particularly commercial queries on desktop. Desktop's a higher revenue, lower margin business for us. So you see that play out in our numbers with lower projected revenue, but margins going up. But that's just kind of an anecdote that we're seeing. We think it's because combination of both people having more normalized work schedules, but also particularly this summer, we believe travel is affecting that as well. People are traveling not in front of their desktop computers and doing more searches on mobile.
That's actually very interesting because that goes into my next question. I wanted to ask why in particular Bing you described as a higher dollar, lower margin business.
ILMN.
I'd assume that's compared to Google, which is the obvious compare for Bing. Is that because what you just mentioned, that Bing is not playing very much on mobile, and mobile had tended to be lower dollars, higher margin?
So Bing would be a little bit more heavily desktop, where we specifically were scaling up our business with Bing was more on the desktop side. So as we scaled that back, I mean, we scaled that pretty heavily since around the middle of Q1, rolling into Q2. As we pulled that back, we still have some buys going on Bing, just to make sure that we're highly confident in the quality of the traffic coming from there. But as we pulled that back, you're seeing the immediate effect, because that was a heavy desktop business for us. And, kind of as I mentioned, that's why we're bringing down the, our total revenue guidance substantially, but, Ebitda is, coming down just a little bit.
From this earnings season, a pretty severe decel from the socials. From talking to the DSPs, they saw things go down in connected television and the like. Can you give any more just overarching thoughts about where in the online ad landscape things are being impacted, where dollars are shifting and how quickly, and how you see this coming out, given that you're kind of playing across the world?
Yeah, so I would say two different areas. As I said, we, at least our view on the kind of CPCs and performance advertising, those look to have been pretty, relatively depressed from what we would have expected. We mentioned in our earlier remarks, when things always reset in July, our systems are ready for that. It's really almost at the end of every quarter, when literally the next day rolls into Q1, have markets reset, and then they kind of over the first month and a quarter, generally tend to rebound. We saw things rebound much more slowly. And so we're seeing that on the sell side. That's primarily where our revenue is coming from, is the pay-per-click marketing side. We're seeing a little bit more depressed consumer queries. So we don't, that's not going to be a long term, over the long term, obviously, people are using the internet more and more, specifically as we were rolling towards the end of Q2 and early in Q3, it looks to us, and now we don't have a perfect view of the entire market, so this is our view of the market. It looks to us like, commercial query volume, was a little bit lower in general. And, what we would suspect, and we flagged this in our remarks, we suspect that's a combination of, certainly on the shopping side, we've seen things be depressed. There's probably some macroeconomic headwinds in there. We think that it has something to do with a bit of increased summer travel as well, which would have a natural effect. You hear a lot about revenge travel this summer. So we're seeing things just, a little bit depressed on the consumer side as well.
Will be available on the investor relations section of the company's website.
As I mentioned,
it is now my pleasure to introduce you to your host, Mr. Jason Wilk, CEO and Chairman of the Board.
And
Thank you,
maybe
Mr. Wilk.
consumers
You may
are feeling
begin.
a little bit better about things.